helps you.
Welcome to Trading Nation. I'm Mike Santoli. Buy the dip is a term many on Wall Street probably mumble in their sleep. And with the S&P still down 7% from its recent highs, it might be tempting to do just that right now. But our next guest says, buyer beware. Pravit Chintawongvanich is equity derivative strategist at Wells Fargo. Joins us now to talk about this market dynamic. Pravit, so is the character of the market changed, do you think, in this last several months or this year that makes it less rewarding potentially to buy these dips?
I think it has. Look, when I think about what ultimately drives the market, there are three things: the fundamentals, the price of risk, and liquidity and panic. Now, I think most people would agree that U.S. fundamentals are pretty good, right? This earnings season has shown us that earnings growth continues to be strong, profit margins strong, we all know that. Let's get to liquidity and panic. There are a lot of different ways to judge this, but liquidity and panic is an interesting one because when panic is very high, that panic can be bought, right? In other words, if panic is driving prices, well, those prices can revert quickly when panic dissipates. And you're not really seeing too much of that. So one indicator I like to look at is the VIX. And specifically, I look to look at if the VIX is too high relative to how volatile the market's actually been. Long story short, we're not seeing huge risk aversion in measures of option protection like the VIX or skew. So we're not seeing huge, I guess, risk aversion in measures of panic the same way we saw in February of earlier this year, August of 2015. Looking at technical indicators like RSI or breadth, again, those don't look very oversold compared to the end of the month. So long story short, I don't think there's a ton of panic priced into the market. Instead, what I think has happened is that the price of risk has changed. The equity risk premium has moved higher. And while that's saying that your expected returns are higher over the longer term, that may not be a buyable dip in the short term.
I see. So essentially, you're saying it's been something more of a methodical decline in equity valuations that isn't really all about sentiment or people liquidating positions. It seems a little bit more responding to things like higher yields?
Absolutely. Look, I think the sell-off we had in mid to late October, I think there was some panic that could be bought there. But the easy money from that has been made, and now you're looking at, okay, multiples have contracted a lot, but remember, yields are a lot higher now. So if you're looking at, okay, what kind of hurdle do equities need to clear in order to be an attractive investment versus treasuries, that hurdle is now significantly higher. And I think that's an important thing to consider when you're thinking about, okay, why is the multiple lower right now when our equity is really so much of a better investment now than they were before? Look, I think as long as the economy remains strong and you get earnings growth, then equities can continue to rise. But you're going to make your money in equities the same way you traditionally do, which is from rising earnings, dividends, and buyback. In other words, I don't see any particular panic or, to me, the risk reward isn't necessarily screaming that you need to buy the dip. I would stay invested, but I wouldn't necessarily go and leverage or put additional money in to buy the dip.
Got it. So as people look at the current market field position, right, we have 6 or 7 weeks left in this year. Traditionally, people are expecting some kind of an effort for a year-end rally. Would you prefer to see a little more of a panic response at some point? Let's say the market goes down to meet those old lows from October. Is that what you're waiting for? Do you think at this point it's just kind of a buy and hold and expect modest returns type market?
Well, look, if we saw a return to the lows and a significant surge in risk aversion measures like the VIX, then I would say, okay, maybe that's a tactical buying opportunity. But right now, I'm not necessarily seeing that. So I'm not saying that I'm not necessarily bearish on the market. I'm saying, look, strategically, if you're invested in equities, then stay invested in equities. But to me, I don't really see this as a tactical point to necessarily add exposure.
And when you say that you often look at the VIX, the volatility index, to see if it's too high relative to how volatile the actual market has been. So right now, with the VIX 19 or 20, you're saying that's basically fine, that's appropriate for how jumpy the market itself has been?
It's actually been bang in line with how volatile the market has been. And I think that's very interesting. Again, if you contrast that to February, August of 2015, you had real risk aversion price in the options markets and real panic. We've been discussing this a lot internally, and one conclusion we came to is perhaps what this reflects is that people are not hedging because they've actually just taken down gross. They've reduced their exposure to the market as a whole and saying, look, this year is done for me. I'm not going to go and buy hedges to attempt to protect myself and gain some upside. I'm just not hedging.
Right.
I've taken down my equity exposure instead of hedging.
Gotcha. So you're just playing smaller, and therefore, and of course, what is spent on those hedges of the index is what creates the volatility index. So the VIX measures the prices paid for those downside hedges, just to make clear on that. Pravit, thanks very much for your perspective here. Really interesting stuff. Appreciate that.
Absolutely. Thank you.
Thank you for joining us today, and thanks for watching Trading Nation. I'm Mike Santoli. We'll see you next time.